All right, welcome everyone to another Rocket Dollar webinar. I'm really excited about this one today. Kind of the joke that we've been using at Rocket Dollar is, boring is good right now. Compared to 1 year ago, a lot of the investment opportunities that we were talking about, extremely flashy, lots of glitz and glamour, high risk and everything like that. And I'm really excited to bring something different here today that, we're looking in this changing rate environment. We have a lot of investors trying to, see how should they adjust risk? What kind of opportunities should they be looking at? Should they be looking to try to make a single or a double hit instead of trying to smash home runs in this huge bull market that we had just a year ago? So we've done some material with Whitney before. We were talking to her audience just a few weeks ago, and we're excited to kind of bring Whitney's passiveinvesting.com style to our Rocket Dollar audience. So Whitney, why don't you introduce yourself?
Yeah, well, thank you so much for having me on. I hope to provide an immense amount of value to everybody here today and those who are listening asynchronously. But my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at passiveinvesting.com. Here's my contact information and ways to reach out to me. I want to, most people say that to the end. I know not everybody can hang on until the end of the webinar. If you want to jot that down, go ahead. But today we're going to talk about how to invest in cash flowing car washes. But I really just wanted to kind of let you know a little bit about my background and where I come from. This is the whole reason why I invest in passive real estate and why I am looking for, stabilized assets in today's environment, but good solid assets where there's, also still some upside potential because they are there. But this is me and my crazy crew. I started off real estate investing in 2002 in the single family space. I was doing live-in flipping and house hacking, and eventually my husband, joined me in my flipping antics and did really well building up buckets of income, but didn't do very well at creating passive cash flow. I honestly didn't even know what it was. Until about 2015. And once I figured out what it was, I was like, oh, snap, that's how you unlock those golden handcuffs and actually get freedom, financial freedom, freedom of time, freedom of choice, freedom of impact. And that's really where our investing portfolio took off. We continued to scale in single family real estate, but then we realized, hey, we need to go bigger and scale quicker in order to unlock these handcuffs. And we originally started off in multifamily, but as you were alluding to, Brandon, like there are still, the environment right now, it's cyclical, it's changing. Multifamily is still strong. It has very strong fundamentals even today. But for those people who are still looking for strong cash flows, we realized that we had to scale in other asset classes as well in order to fortify our portfolio. Just to give you the audience a quick snapshot, we personally, myself and my husband, we have over 6,300 multifamily and residential units in our portfolio, 1,400 self-storage units, a hotel, 16 car washes. So, definitely very versed in this background from an operational standpoint, but the impact that it's created for us, learning about how to invest in passive real estate, as well as, just about operators, markets, and deals, it's allowed us to have 100% freedom of choice on how we spend our time. And the impact I get to create here with my time is to be here and educate your audience. And we can do the exact same thing here at Passive Investing. We can help you guys do that. Just some quick numbers. We have 1.3 billion assets under management at 26 IRR to our LP investors. But that, I'll kind of pause there. That's like the background, but I don't know if you were going to throw a disclaimer. I'll go ahead and do it myself. Anything we cover today is not financial advice, legal advice, tax advice. Make sure that you consult with your team before going in any investment, even consult, with your SDIRA company like Rocket Dollar.
And Whitney, a lot of the presentations Whitney does, we like to really pause for questions and stuff like this. So we'll be keeping a little bit shorter presentation today. Still feel free to pop in those questions. I'll definitely interrupt, or kind of at the end of a pause, bring them up so Whitney can answer those. And if your question's related more to a self-directed IRA, please feel free to answer that question. Just know we might have to wait a few minutes. If it's specific to your situation, we might have to wait till the very end, or you can call our team, our sales team, to get an answer for that.
Awesome. Well, and Brandon, kind of like to stack on, what you were saying earlier about boring's kind of good right now. We've all read the headlines. I mean, inflation is at 40-year highs, recession's here, recession's coming. Depends on, who you're listening to right now. All the signs are pointing that, we're in a kind of a choppy water environment, and that there may be blood in the streets. But I really love this quote by Nathan Rothschild, and I think we're all familiar with it: buy when there's blood in the streets. But it's the second half of the quote doesn't actually get publicized very much, and it's the second half is, even if the blood is your own. And so this is really something that I try to work with investors and educate them on, is that you have to learn how to continue to find assets, invest in assets that are based on principles that have multiple pillars of building wealth, in order to succeed and really respond to any environment. Now, guys, hang with me here, because we are going to talk about car washes. I'm super excited about this $27.8 billion industry that has an immense opportunity for just natural upside growth even during a recession. But I want to touch on these principles really quickly, because I think whether you actually ever invest in car washes or not, if you just go and look through your portfolio, take an assessment, right now, of what assets actually adhere to conservative values of principal investing. I mean, and these aren't values that I created or principles I created. This is, after years of studying the Vanderbilts, the Carnegies, the Rothschilds, Warren Buffett, Ray Dalio. There's some through lines here. And, to kind of navigate a choppy water environment, you need to look for assets that have elements of capital preservation to them, cash flow, equity, tax benefits. And I'm not saying just one of these, I mean, all of them. That way you can get paid multiple ways at once. Especially in this environment, I would look for assets that have some sort of inflation hedge. And this is one of the reasons why I love car washes. We'll talk about that. And then make good quality, safe use and arbitrage of leverage. And then we'll get to my last principle here at the end. But why invest in car washes? Car washes, first of all, I want to kind of root it. It's not real estate per se. This is a $27.8 billion business industry that is posed for immense growth over the next few years. I think one of the pushbacks that I get from investors, they're may come from self-storage or a multifamily world where you can only have one roof over your head, or maybe it only makes sense to have one storage unit per customer. But this is a retail business. And as we look for that, there's immense growth that we can create in this type of retail business. We always, look at it through the lens that if you look at how many gas stations are on every single corner, or, Jiffy Lube shops, all of those shops are doing really well because people have cars and they need to be able to service them in multiple areas. Here's the thing is, as electric vehicles come online, more widespread use, gas stations and Jiffy Lubes are more prone to probably stumble in that future economic environment. Car washes aren't. Even if you have an electric car, you still have to wash it. And that kind of leads to the behavior piece. Once the behavior of washing a car is actually established, and over 89% of the United States washes their car at a professional car wash. Once it's established, people don't give it up, okay? So these are all just kind of some little stats to throw out there. But let's kind of start back with what kind of car washes are available. There are really 4 different types of car washes. You've got your, your in-bay car washes where you kind of drive in and maybe you take your kids to help you wash the car. You got the foam brush and you're, feeding coins and quarters. I'm just praying my 10-year-old does not spray me with the hose when we go to that type of car wash. There's that. There's also the car wash that's attached to a gas station. That's another type of car wash. You only get 3 or 4 cars deep, and your customers aren't going to wait around if there's a line. Then you have on the other spectrum, you've got your full service car washes where you might get 20 or 30 cars going through within an hour. They might go through a short tunnel, and then you have, people that are drying off your car at the end by hand. But really, if we're talking about the ability to preserve capital and growth, you have to have scalability with the asset right now. And I'll talk a little bit more about that when we get into our equity growth positioning with car washes. But that's where express tunnels really come into play. We're looking for car washes that are about 60 to 80 feet, the tunnel length long. And really, it's all automatic. You can get, hundreds of cars through a day, like maybe 400 or 500 cars through a day, and have it really manned by 1 or 2 people. So there's a great, balance there of labor and profitability. Now, when we talk about capital preservation, right? Like if we stack it up against these principles of investing that I really like evaluating my assets with, we're positioned, I would challenge any investor to look for, car washes that are well positioned in growth markets. Like anything else, location, location, location. This is where it really starts kind of overlapping with the fundamentals of real estate. Also with car washes, you want to make sure that you own the land that the car wash sits on. Okay, very important from a business model. One, there's just another, stream of upside potential there as the land appreciates. But 2, from a business perspective, you want to make sure that you're actually, as a car wash owner or investor, that the land is owned, so there's not additional expense risk, as leases get renegotiated, or the potential for the land to be sold out from underneath the business and maybe potentially to a developer. So also there, it helps you control the exit of the asset if you own the land. We touched on a little bit about cash flows. We like particularly the express tunnel car wash arena for scalability. But that really helps us generate an immense amount of cash flow on that asset. And we encourage anybody that's investing there to look for that.
Yeah, and Whitney, we had a question come in that, I know you'll probably get to it, but I think this helps give people some context, is when passive investing, is kind of gathering an investment opportunity or looking at some of these car washes, are they gathering something like maybe 10, 5, or 15 like car washes together? Or are investors just saying, hey, I'm investing in this one car wash in like Lockhart, Texas?
Well, for us, and as far as our strategy, and I can definitely touch on our strategy right now. We are buying, majority of these car washes are actually owned by mom and pop owners. Okay, and I'll tell you why here in a second. But they own maybe like 1 to 4, 1 to 5 car washes. Hardly anybody owns more than that. Why is that? Is that they are operating themselves. There is no third-party management. So then, the natural question is like, why is passive investing getting into this? Is that there's no third-party management? Well, that leads into our equity growth lever here. We're actually building the first third-party management company for express tunnel car washes. Now, this differentiates us from other people's, there's other operators out there doing car washes. They're buying car washes in a franchise model. They don't own the brand. So if somebody else in their town has a car wash of the same franchise brand, and they're subject to whatever the other car wash is doing. For us, we have direct ownership of the entire brand. Sure. That gives us immense buying power too. It also gives us immense, power to control our expenses on the operation. Now, how we pick up car washes, we're going to do it 2 different ways. We're going to do it either through an acquisition strategy where we're grouping, looking for those mom and pop operators that have that maybe 5 units under ownership and taking them all down. or grouping small portfolios together. We're also going to be doing ground up development. And our overarching business plan with the car washes is to acquire 200 to 300 locations and IPO this. Now, that's certainly not the most conservative way. That does not adhere to Brandon's initial comment that boring is good. But the thing is, we're actually underwriting each car wash for individual exit. So any numbers and any returns that we're showing our investors is for the most conservative way that we could actually, and the most laborious way we could actually exit the portfolio, which is individual sale and exit. But our top line exit strategy is to acquire all these locations and IPO them and keep our investors in. So I know other questions are coming in, but if I can continue going through the strategy if you guys want.
Okay, we can just pause and answer 2 more quickly,
Yeah.
and then we can kind of roll on. So Nick was kind of answering this in chat, but are you accredited only for this investment or kind of all investments on the platform?
So currently with passiveinvesting.com, we work with accredited investors only. Now, we do have additional pipelines or products that will be coming into play here over the next 6 to 12 months, where we can work with sophisticated investors.
Got it. Great. And then Anish asked, this depreciation questions are usually related to not retirement accounts. So just to take a step back, when you're investing in a deal like this, a real estate deal, sometimes people come from the taxable world and they say, hey, what's the depreciation? That's like a huge amount of the value that an investment might bring. In an IRA, you generally have to pass on that depreciation because you're getting IRA tax benefits and protection from capital gains. But Anish is asking, so Whitney, let's imagine that there's no IRA or 401k in the picture. Is depreciation passed on to the LP investors when they're doing deals like this?
Yes. Yeah, so we have a similar depreciation strategy as maybe a lot of people are familiar with multifamily or self-storage. We're going to perform a cost segregation analysis on all sites in the portfolio, and we're going to accelerate any benefits that we can to the first 5 years of the hold. Now, this is considered what we call book depreciation, so it's going to be handled as if it's so we're going to be depreciating equipment as in the business. But it smells like and operates like, depreciation that you would see on a multifamily asset. Now, I don't have it here. I said high year 1 depreciation. We are looking closer to 70 to 90% year 1 depreciation because of how we depreciate all the equipment.
Great.
So for somebody who's looking for, that type of benefit, this is a great opportunity. And I know we're staying on the education front. If somebody is looking for that to occur this year, email me ASAP, because we do have a couple opportunities where somebody can get in on our most current fund. It's almost full. Otherwise, we would be looking at that depreciation to kick in for them into 2023 with their next fund.
One last point on the depreciation, and then I'll let you get back to kind of the education on the different types of growth and flow there, is we always get this question. This is the follow-on. I like to do this investment on a retirement account, but I'm sacrificing the depreciation. Like, why do I even bother? Like, why would I even do something like this? And the short answer is you get a couple other benefits. So there's trade-offs. You get capital gains protection. So let's say farther along down the line, let's say there is an exit of one or multiple properties or parts of the investment. If there's a large capital gain, and if you're on a traditional IRA or a Roth IRA, you are protected from paying immediate capital gains tax on all that investment. If you're in a traditional IRA or a 401k, you could slowly take the money out and only receive a small, tiny income-based tax hit each year. If you're in a Roth IRA, if you have a huge gain, as long as you leave that gain in there for 5 years, you will be totally protected tax-free from that. And the last part is bonds are pretty brutal right now in a lot of different areas. The bond market is a lot bigger, honestly, than some of the public markets. There's a lot of debt moving around different parts of the economy, but they're struggling to, position that, and with the changing interest rates. So a lot of retirement investors, they get a larger amount of bonds in their portfolio because that's the traditional conservative mechanism that you use. I want to reduce my stock equities, I want to get yields, and I want to get protection in bonds. With interest rates kind of making havoc in the bond market, a lot of people say, all right, I want some bonds, but I don't want all of my retirement portfolio in these bonds getting disrupted by interest rates. How can I find like a nice replacement for those bonds that's kind of paying a yield? So a lot of people look to real estate investments or cash investments. That's like something like this.
Yeah. And I love how you touched on the gains piece. For our, an example of what you could expect in one of our funds is a 10% preferred return, 60-40 split to 20% IRR, 40-60 split to 30% IRR, and then 10-90 afterwards. And so, based on a 5-year hold, conservatively, we're probably, definitely over 3x equity multiple with this type of strategy. With us eyeing an IPO, we could, step up closer to 14x exit for our investors. But now, again, I need to highlight the fact that you're investing in an operating business, that it has an underlying real estate component to it. So it's a retail business, right? It is different than just like your run-of-the-mill multifamily residential type of investment. But it's definitely still, because it has these multiple pillars, we're definitely hedging the risk profile of the asset. Couple of things I did allude to, like how our portfolio is being formed, our acquisition strategy. Again, acquiring operating units, as well as we are going to do ground up development on some of these units as well, in order to get to that 200 to 300 count. But when we look at the operation, the acquisition strategy, again, the reason why that hasn't happened, the reason why big money hasn't gotten into it, is because there's no third-party management, strategy here. And if you think back to like 2007, 8, and 9, this is where self-storage was then. There was no third-party management companies back then. So we're really at the early consolidation phase of a very new asset class. And big money is very interested in this. And so we're trying to get ahead of the curve. We're trying to be one of the first entries to market as opposed to one of the last. We already talked about the depreciation. We talked about this is the last year for 100% bonus depreciation. But I'm not really sweating it right now because it's ticking down over time. And we're going back to those 2017, pre-2017 levels of bonus depreciation. Now, the last reason why I really love this, well, I shouldn't say last, but one of the, if we're evaluating our pillars, I really love this asset class, especially direct ownership of an express tunnel. Very different. I can compare and contrast to investing in a franchise, but this direct ownership is that we have control over the subscription model. So say your subscription is $25 or $30 a month. That is a very low cost of entry for the household, right? It is not something they're going to get rid of during a recession, an expense they're going to get rid of. For me as the business owner, it costs about 80 cents to $1 to wash the car. Now, our average subscriber washes their car about 2 times a month. So now that number, that $1 per car wash, does not take into account labor. So, it is a little bit more costly, when you take into the full expense of washing a car, but we have very hefty margins here. As we go into any sort of choppy water environment, to adjust the expenses, either upwards or down, in order to, keep a high customer count and flow at these locations. So I know questions are coming in. I always just like, kind of like wrapping up, my conversation is with opportunity costs. I think this is, I speak at a ton of events. I just spoke at Bigger Pockets here about 2 weeks ago, and we had this conversation around opportunity costs. For those people who are sitting on the fence, on the sidelines going, I don't know what I need to do, so I'm not going to do anything. Let me give you a calculation on how to figure out opportunity costs within your portfolio. That way you can make an educated decision whether sitting in your current asset or sitting on the sidelines is actually worth it in the long run. So the math around how to calculate opportunity cost, and really what this is an investor, what is the impact to their portfolio if they don't choose the next best alternative? Okay, they stay in their current asset. So what you do, let's say an investor is in a CD that yields 2%. If you guys know a CD that's yielding 2%, let me know, because that would be pretty cool. But they're looking at an asset that's going to yield 10%. Do I do it? Do I not? Well, let's take a look at the opportunity cost. You got 10%, okay, what you haven't been doing, minus what you currently are doing, 2%. That gives you 8% opportunity cost. But now we have to actually convert that to dollars. And if you're looking at $100,000 that you have invested, that's an $8,000 a year opportunity cost. Now, that's where most people stop with their calculation of opportunity costs. But I want to encourage people to look at it. You're also not making that $8,000 in year one. So now you have to compound that loss out over time. And so if your investment horizon is 30 years, you still have to compound it out another 29 years. And so, really, by not choosing a stable, conservative investment, right? I'm not saying don't invest in just anything. That loss is really almost $127,000 over 30 years. So I just wanted to give you, here are all the things that I know a lot of people that are currently in. They're in cash, gold, crypto, paper assets. Here's what, a lot of real estate is yielding conservatively in today's environments. Why are they still able to yield those numbers? Is because they adhere to multiple pillars of investing, including our wealth accelerators. And so when you compound out, what does that opportunity cost actually look like? It can be pretty staggering. For us, we're talking about car washes today. And so if you're debating, do I stay in all cash where I'm losing almost 9% of my money? I pulled these numbers from at the beginning of September. It was 8.5 at that point in time, versus going into a car wash opportunity that's yielding, 25 or 30% IRR. Minimally, your opportunity cost is close to almost 29%. So really, at the end of the day, when you take a look at your assets and you're evaluating, do I want to go into an asset class like a car wash? Make sure that you want to make sure you're investing in assets that have multiple principles of wealth building to them. So you can actually, take on asymmetric risk and mitigate returns as you build your portfolio. So I know some other questions have come in, more specific to car washes, but again, I'm an educator. And so it's so hard for me not to go into those educational, touch on those educational principles.
I think there's a good one of, I have actually seen this article. I can't remember, it was the Wall Street Journal. There was like a little buzz on like finance Twitter, because people even who are not familiar with self-storage have started to recognize that space has become more professional. And I think people saw some news stories that they're coming into car washes. And they go, oh boy, get ready, car wash owners and stuff like that. So someone says, have you seen acquisition multiples expand on the recent news that private equity is now moving into the car wash space? Asked by Brian.
Really, no, we have not seen that happen. I think, I think that announcement kind of came in a little too late to really, move the equity multiples. What we've seen is like anything with all the real estate asset classes, a seller is still they're trying to command a higher dollar amount than what the market really allows. And so, remember, we still have, we're still acquiring these car washes with lending. We're starting to see a lot of these, that kind of trend unwind a little bit, but I don't think the announcement that big equity is coming in is really moving the needle. And that's because of the third party management that has not been solved yet. we enter, we're looking for our car washes. We're looking to enter at about a 7 to 8x equity, what we call EGI, which is similar to like NOI, net operating income, but it's a way to measure profit. We're looking for those assets to have about a 53 to 55% expense ratio. Our current holdings are somewhere between 48 and 55 entry expense ratio. We're looking to drive that expense ratio down, increase the EGI on the asset. And even if we had to exit individually, we would be exiting closer to like a 10, 11, or 12 X on the EGI. So for those people who love like talking about numbers, right now sellers can't, the seller that we're buying from really isn't able to command that higher equity multiple or EGI multiple.
Right. Yeah. And the other question, was about a specific brand of car wash, Tommy's, but I believe when I was just took a look at their website while you're speaking, that seems like a franchise opportunity to me. And
it is.
can you briefly explain like what would be the difference of a franchise compared to a fund? From my impression, a franchise is a much higher barrier to entry as far as like dollar capitals that need to enter before you can get started on something like this.
Yeah, so there are other equity groups out there that are going the franchise model as opposed to direct ownership. So they're having to build locations. And so what they're doing is you're seeing, and there's no right or wrong way to do this. But I'll explain and I'll reiterate the biggest downfall that we see by doing it this way, the franchise model. The franchise model, you're having to, acquire land, you have development costs, and then you have to operate the fund. And normally the investors don't get to choose, do they want to be in the development or the operation side? They have to be in both. And so from an investor standpoint, that may not even like really be something that they want to do.
Double the exposure. Yeah.
Yeah, we can pick apart that exposure. We actually do development, but we have two different funds. If you want to participate in development, fantastic. Here's our development fund. Our build time is about 12 to 18 months. Yields about a 31% ARR. And great. If you want to be in the operations, fantastic. We can move you over to the operations fund, but we allow our investor the flexibility to choose their risk exposure. But the biggest thing between the franchise model and what we're doing, the direct ownership, is being able to manage that brand end to end. So let's say I went in the franchise model and you owned operations on the other side of town in the same franchise name. And I operated mine, pristinely. And then Brandon, you just kind of like really didn't care. You were kind of
it in. Yeah.
You're an absentee owner. The problem is our businesses are tied together. I don't. Now there should be brand standards in place. Hopefully the franchise owner would step in, but my business is now impacted because of some actions that you took and I can't control. So that's why we're going the direct ownership, so we can control everything, end to end for our investors. It's kind of the different, if anybody's invested in single family real estate, it's the difference between like going with a horizontally integrated asset versus a vertically integrated asset.
Yeah, and I just, the one of our watchers kind of brought up a certain brand. I did a look through their website. You're looking at 1 to 1.5 million to even get started in an opportunity, and that might mean gathering money from yourself or other investors who then could be committed or flake out on that opportunity throughout the process. That's a really high barrier to entry. If that works for you and you're willing for those challenges that Whitney talked about, you can go for it, but just know that there are additional challenges that passive investing, that kind of passive investing moniker, people bring that up because that keeps them clear of a lot of different day-to-day headaches and issues that you might run into.
Well, and if you want to own your own business, fantastic. Or do you want to invest in somebody else's business, a team? And that kind of brings me to my last principle. Do you want to invest with experts who are doing this professionally? And, you can put a little bit into each fund, right? You could diversify across funds, which actually helps you diversify across the asset in the deal. One of our funds had 4 assets in it. Another one of had 7. They're all over across the East Coast. So the Carolinas, Virginia, Florida, Georgia, Tennessee. So, we're very rooted in that Southeast. We do see ourselves expanding that model pretty quickly. We just started there so we could work out, the development of our third-party management company. But really, when you get into investing passively, you want to invest with somebody who really, truly understands the strategy and has the expertise and track record. We just actually recently closed 2 more car washes. So we're actually up to 16 car washes right now. We have the ability to secure the credit and lending. If you're putting in 1.5, fantastic, more power to you. But getting lending in the space is actually can be really challenging. And we have that puzzle piece figured out. We have over 2,000 happy investors. I know this says 1730. We just walked away from our board meeting yesterday, and our IR team updated our stats for us. And we just have a team working on behalf of all of our investors to help them, find the assets that are going to fit best in their portfolio, but really, help, acquire, maintain, and dispose of the assets for them on their behalf. Awesome. I'm pretty much done. I'm ready for questions, guys. I know we've got plenty of time here. If you want to reach out and learn more about this asset class or any other ones that we have open, like the multifamily, self-storage, and hotels and real estate debt, you feel free to you can try to use the QR code. But you can also hit me up at passiveinvestingwithwhitney.com or email me directly at whitney@passiveinvesting.com. And, I'd love to hop on a phone with anybody that is really interested in this asset class, and we can figure out if it's a good fit for them.
Got it. Thank you, Whitney. And what's the best way after they do reach out? Do you do kind of webinars on your own, or you kind of do one-on-one investor conversations?
I do both. I actually have a weekly webinar. You guys were featured on it at the end of September, but I have a weekly webinar for people to attend to continue to deepen the education about all things passive investing, not just on car washes. And then, when you go to passiveinvestingwithwhitney.com, enter your information, you'll get immediate access to my calendar in order to schedule a call.
Great. Yeah, we had a question about like really specific parts of each fund. The 2 opportunities are open. I think, the investor can kind of go specifically to that and get a nice personal follow-up, or tune into some of those weekly webinars that have some of those other details in there. Yeah, so please give your Q&A. I'll kind of coax a few questions here, but if you have a few others, please bring them up now. You can also look at, I'm going to put passiveinvesting.com in the link here so everyone can navigate to that.
Yeah, and more importantly, Brandon, if you'll drop in passiveinvestingwithwhitney.com if they want to it's a sub-page on the passiveinvesting.com website. But if you want to jump on the phone with me, that's the only place you get access to my personal calendar and those freebies that are listed here.
Got it. I'm getting that just a second here.
Yeah.
With Whitney. Okay, I want to make sure my URLs are right before it sends me to some dead link, which I don't want to send anyone. All right. And with those 2 fund opportunities, are you kind of currently raising for both of them? Or you said one's kind of close to finishing. Where are they at right
now? Yeah, so we are constantly opening and closing funds. If you think about it, we're at 15 or 16 locations right now. We're looking to get to 300, and that's our moonshot goal in 5 years. So we are going to be opening and closing funds fairly rapidly. If somebody's interested in an operational fund, and when I say operational fund, that's the one with all the tax benefits and the cash flow. I have a little bit of space in our most recent fund now. Great. Somebody wants to kind of kick the tires, just know we'll have another fund opening up here in the next couple of weeks, probably I would say early mid-November. But all the assets in that fund won't close until January 2023. So they would expect to see that ramped up tax benefit into next year.
Okay. And I know we said you're accredited only, but what is the minimum investment usually for these deals? And does it kind of vary from deal to deal?
It does. It can vary from deal to deal. It's 75 to 100K. Depends on how many assets that we have in there. We've done as little as 2 assets in a fund and as many as seven in a fund. And so that can give somebody instant diversification. If somebody is new to passiveinvesting.com, just reach out to me directly. We can certainly, work with, an investor, on what's most comfortable for them.
We had a question about paper losses. I think this one is best to send Whitney individually. So thank you for the question. I think you should definitely send her a personal reach out on this one, and then she can kind of expand on that. That one would be a doozy to get into just live here.
Oh, we're talking about rep status and all that sort of stuff. Yeah, that's tax advice there. But I'll reach out and give them my email.
Yes, sure, reach out. And I'll just keep asking a few, and then we can close up in a few minutes here. Still feel free to pop up your questions, if they're general or for Whitney. But when the deal variety, kind of at passiveinvesting.com, the deals you work with your team, what would you say is like how many car wash? Or I see self-storage up there. I also see multifamily. What tends to be the split? Because I know car washes are more of like a niche type asset.
Yeah, so we are investors. Our general partnership and a large portion of the staff, we invest in our deals as well. So we do realize that the real estate market cycles. So we're not just like multifamily all day long, multifamily or bust. No, we do realize that asset classes cycle. So let me stop sharing really fast, and I will pull up some hard stats again based from our end of the year directors meeting that we just wrapped up. But from an acquisitions standpoint, this last year we acquired 3.86 million in multifamily, 19 car wash sites. Not all of them have closed. So in our self-storage, we acquired 11 facilities in 14 months, so 120 million assets under management there. We were also voted the top 100 operators in self-storage, so we're really proud about that. So we're looking to offer multiple verticals for our investor so they can diversify their portfolio. Within our operations, but at the same time, I would say we've put out probably since interest rates really started taking off, we've closed 3 multifamily assets. This will probably be the last multifamily. We have a multifamily asset currently open. It will probably be the last multifamily asset that we close this year, and we'll just wait to see what the environment gives us. Again, since our operations is spread out over multiple verticals, we can really respond to what's happening in the environment.
Yeah, and just so the audience watching knows, when like a partner or an issuer kind of approaches Rocket Dollar, say, hey, we have some people that use self-directed IRAs, blah, 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 we like to do education. A lot of those partners that we deal with kind of have like one specialty. They really only do one asset no matter what, all day long, no matter how the environment is. So I found that really interesting when Whitney's team approached us and we started talking, hey, there are active deals kind of in all of this different variety. Show some real flexibility there. That not a bad thing, but a lot of our other partners just say like, this is what I'm an expert in, I'm sticking to it. So Brian asked, and I know none of this stuff is guaranteed, whatever, but he asked, when you mentioned an IPO, kind of hopefully people always are worried about the entrance and the exit of an opportunity. Brian asked, would the IPO and the thoughts for that potential IPO be around operations funds, development funds, or both?
So just to explain the acquisition strategy, for us to get to 300 units in the time frame that we want to get there, we're going to have to do an acquisitions as well of, of existing car wash locations and develop our own. And so when we do develop a location, we will essentially sell that location to an operational fund. So when we talk about the actual exit of all locations, that is on the operational funds, but we're using the development funds in order to build the portfolio.
Got it. Great. Thank you. I think we answered this a little bit earlier, but Anish was asking, is this fund like really blending across many locations or just 1 to 2? I think you mentioned a couple states and groups of 4 to 5 properties, sometimes being bundled together.
Yes. Yeah. So we're constantly, acquiring properties. So within a window, so say like what underwrites well and makes sense to acquire in say like an 8 or 12-week window. And then we're bundling those purchase and sale agreements together and taking them down at one time with one loan. So sometimes that's 2, sometimes that's 4 or 5. Earlier this summer, we were able to take down a portfolio of 7.
Okay. And when you approach some of these smaller operators, like, because I don't, really know about the industry, you've been looking at it. Let's say you find like one smaller operator and they have 4 properties. Do these tend to be kind of in the same city, or are they more like spread around maybe like a 2-hour radius or like a whole state?
I would say they were more closely bundled together in either a city or a region. And, because remember, there's no third-party management. So it's one single owner operator that's having to manage.
And they want to be able to drive to each individual location usually.
Yeah, probably like within an hour or 2 of each other. And that's about it. For us, the way we're building out our management company, we have over 130 employees currently right now within the management company, from on-site staff to regional managers. So that is something that we are really taking into account and learning about as we grow the portfolio, how we are going to geographically disperse that workforce. But in the acquisitions, it's really tightly knit around geographical centers. Now the portfolio, we might have say we open a portfolio of 7. It might have been an owner operator that had 4 locations and another one that had 3, and we were able to bundle those together at the same time.
Great. Yeah. And just a, more personal experience commentary, please, last call for questions, I think, if you have one. But I moved from Chicago, I barely used my car in that city, and I had a couple great car washes I loved. And I moved to Austin, the most car-centric place I've ever lived in my life. And the car washes were terrible in the downtown area. So I really hope that, maybe sometime Passive Investing kind of opens a few of these. I did finally find a good one in the suburbs near me, but compared to a much less big of a car city, really not up to snuff and dissatisfied. Things that didn't even operate well when you go through made my car dirtier, non-operational machinery. So excited to see, there's some professionals kind of stepping in this place and helping out some of those local operators to see if they can scale better.
Yeah, definitely. Cameron, we have such an amazing team over this particular vertical. We don't just have 3 managing partners overseeing all 5 verticals. We have managing partners overseeing, 1, maybe 2 verticals. In this particular arena, we have Cameron Broom, who is our managing partner of car wash operations. I mean, he comes from a huge background in supply chain management. I just really can't even begin to go through his resume there, but he's very knowledgeable in the space. One thing though that he's looking to do when he sees these locations, he gets really super excited about all the different improvements that he can put in place, not just from the normal how can we renegotiate vendor contracts and get our supplies cheaper, and how can we have better utilize our employees across multiple locations, but we're talking about optimizing the actual the drivetrain of the tunnel itself. How can we put in water recapture systems so we're not at any we can actually improve the environment that these car washes are in, as opposed to dumping more water. in the water supply, we're dumping less. If there is some sort of like water shortage, in the future, we actually can recycle that water and get it clean ourselves. So there's all these sort of things that his brilliant mind can just like wrap itself around. I'm in awe.
Great. Yeah, and I don't know if you'll be able to share specific numbers, so I'm not going to ask that, but I've seen this interesting is I noticed that there was a subscription to that car wash I ended up liking in the suburbs, and that's really new to me. I had never seen that, and I've seen that talked about a few times. So how do you see like the growth of subscription-based car washing compared to like 10 years ago when I don't know if that really existed or that was just kind of a local, non-professional thing?
Well, I mean, that is exactly one of the things that we're doing, not only rebranding the car wash, increasing income, decreasing expenses, adding additional streams of income like pet washing on these locations. It costs like $200 for like, a steel tub and like a hose, and then you can charge in an extra $10 to $15 a month to wash your pet. I don't know about you. I hate washing my dog at home. So that's it. And if I'm going to go wash the car, wash the dog. So I have a clean dog and a clean car. Now, back to the subscription models. This is a great way to stabilize revenue and to do it pretty inexpensively. So we're looking kind of to do the Chick-fil-A model and providing such an immense amount of value for, say, $25. Different types of shines, tire shines, the wax that goes on the car, the vacuuming, all of that, to where the customer can't say no, between our location and another location. And because we have direct ownership, and then because we can do this at scale, it's really going to make us far more competitive than those franchise owners. As far as the dollar amount, we're going to have subscriptions at 25 all the way up to 45. As far as the number of car washes per location, that's going to be a function of the traffic count, the location, and also the tunnel size, the tunnel length.
Yeah.
So for a longer tunnel, you can get 400 or 500 cars through a day, if not more, because you can control how fast those cars go through. If all of a sudden you're getting a higher traffic count, before you need to actually expand the tunnel, you can actually just move the cars through faster and wash them quicker. Really that's what we're, probably one of the biggest drivers for us is in our acquisition underwriting is location, the tunnel length, and then also the traffic count going by.
Yeah. And I was this close to getting the subscription last time, but I used to have a crappy Civic and I would just let the Texas pollen cover that thing till the end of days. But I haven't I got a newer car that now I feel like I have to take better care of it. So they're this close to getting me subscribed at the local car wash.
Yeah.
Whitney, thanks so much for stopping by. This is, a new asset class. I think we obviously got some questions of people that have looked at this a little bit before, but I think most people have never really heard of this type of investment class before. So thank you so much for stopping by.
Yeah, absolutely. Thank you so much for having me on, and feel free to reach out to me directly if you have any questions.
Great. And this will be going up to YouTube right after this. So we look forward to that. And if you're watching on YouTube, thank you so much for stopping by. If you'd like to talk to Rocket Dollar about a self-directed IRA, you could just email our sales team at info@Rocket Dollar. Nick, myself, or Tristan, we'd be happy to answer your questions there. All right. Thank you, everyone.